Welcome back to the deep dive. Today, we are plunging into a topic that is absolutely foundational to modern finance, even if it sort of flies under the radar for most people. Secured transactions.
hmm
We've got a really detailed outline here covering Article 9 of the Uniform Commercial Code, basically. The playbook for lending money when property is used as backup.
Yeah, and our mission in this deep dive is really to cut through the complexity. These pages are dense.
Right.
We want to extract the core knowledge, understand the fundamental concepts like what makes a loan secured, how lenders establish their rights and collateral, and what happens if the borrower can't pay all without getting bogged down in, well, excessive jargon.
Exactly. You might be thinking, why should I spend time on UCC Article 9?
Yeah, sounds pretty dry.
It can seem that way. But the truth is, if you've ever taken out a car loan, financed furniture, or run a business that borrows against its equipment or inventory, you've directly encountered these rules. Grasping the basics is honestly incredibly powerful for understanding your own financial landscape and how these arrangements actually function behind the scenes.
It's a system built to create predictability in lending, which is just essential for the flow of commerce. We'll follow the logical paths laid out in the material, moving through the key stages.
Mm.
First, how a security interest is created. That's attachment.
Attachment, okay.
Then how a lender makes that interest stand up against claims from others. That's perfection.
Right.
How conflicts between multiple claimants are resolved. Hello, priority.
Priority, okay.
And finally, what happens when a borrower defaults, covering default and enforcement.
Okay, let's start at the very beginning then, based on what this outline tells us. What fundamentally is a secured transaction?
At its core, it's when a debtor obtains credit, maybe buys something, and grants the creditor a security interest in specific personal property or fixtures as collateral.
Collateral.
Yeah, collateral to secure that payment or performance. Think of the security interest as the lender's conditional right to that specific property if the debtor doesn't fulfill their obligation.
So, like my car loan example earlier, the bank gives me money to buy the car, and they get a security interest in the car.
Precisely. Exactly that. The car serves as the collateral, and the outline identifies the key players involved. You've got the secured party who holds the security interest, usually the lender.
The lender. Right.
Yeah, a blogger who owes the debt, often the buyer.
Okay.
And the debtor who owns the property being used as collateral. Also, usually the buyer, though. Sometimes the obliger and debtor aren't the same person.
Got it. And this material seems to put a huge emphasis on classifying the collateral. Why does it matter so much what label you put on the property?
Oh, it's absolutely crucial. This classification dictates critical steps down the line, how you properly create the security interest, how you perfect it against third parties,
Okay.
and who wins in priority disputes later on. You get the classification wrong, and, well, you could find your security interest is invalid or maybe ranked lower than someone else's claim. It's a big trap.
Okay, let's unpack that classification then. The material splits collateral into tangible goods and other collateral.
Right. Goods are basically things that are movable when the security interest attaches,
Yeah.
plus specific items like fixtures, standing timber, unborn animals, crops, manufactured homes.
Right.
But the really key point for goods is that their classification depends entirely on the debtor's principal use of the item.
The use.
Yes, the principal use at the time the security interest is created.
So the same computer could be classified differently depending on whether I use it for my personal blog versus, say, my business accounting.
Exactly. That's the perfect example. The outline breaks down goods based on that use. Consumer goods. If the debtor is using it primarily for personal, family, or household purposes, your home computer, your TV, farm products. This covers crops, livestock, unmanufactured products of crops or livestock, and supplies used or produced in farming operations.
Right.
Inventory. Goods held for sale or lease, like cars on a dealer's lot or stuff furnished under service contracts or raw materials. Work in process. Materials consumed quickly in a business.
Okay.
And equipment. This is kind of the catch-all category for goods. If it's not consumer goods, farm products, or inventory, it's equipment. Think of businesses, machinery, computers, delivery trucks.
Gotcha.
The outline also notes that embedded software, like the software running the equipment, is considered part of the goods, but standalone software, that's usually a general intangible.
That distinction based on use is fascinating. So the other collateral categories don't rely on the debtor's use.
Correct. Their classification depends on their inherent nature, not how the debtor uses them. The outline lists 9 types here. It's quite a list.
Okay, let's hear it.
All right. Chattel paper. A record showing both a monetary debt and a security interest in goods, or a lease of goods.
Yeah.
Think of a car dealer's financing agreement.
Okay.
Documents. Documents of title, like bills of lading or warehouse receipts. They represent ownership rights to goods held by someone else.
Mm-hmm.
Instruments. Negotiable things like promissory notes and checks, and also some non-negotiable ones like CDs.
Right.
Investment property. Stocks, bonds, securities counts.
Mm-hmm.
Accounts, this is a big one. The right to payment for property sold, leased, licensed, or services rendered. Basically, a company's accounts receivable.
Okay.
Commercial tort claims. Tort claims held by an organization or by an individual if the claim arose from their business or profession. Importantly, this excludes claims for personal injury or death of an individual.
Ah, okay.
Deposit accounts, bank accounts like checking or savings,
Yeah.
but not investment property accounts or accounts evidenced by instruments.
Got it.
Letter of credit rights, the right to payment under a letter of credit. And finally, general intangibles, the residual category, anything else. Copyrights, patents, trademarks, standalone software, that kind of stuff.
Wow, that really covers a lot of ground. The material also has a note on how you figure out if something is an instrument, chattel paper, account, or a payment intangible. It says you have to follow a specific order.
Yes, exactly. There's a defined path to nail down the classification for rights to payment to avoid getting it wrong.
Makes sense.
The outline also touches on other transactions Article 9 might apply to, like certain leases or consignments that really function like security interests. But it emphasizes that straight sales of property generally aren't covered, unless the security interest is specifically in the payment obligation itself, like taking security in a promissory note someone gave when they bought real estate.
Okay, that lays the groundwork on parties and collateral. So how does the security interest actually become legally enforceable against the debtor? The outline calls this attachment.
Right, attachment. Under Article 9, for a security interest to attach, meaning it becomes enforceable against the debtor, three things have to happen.
Three things. Okay.
1, value must be given by the secured party.
Value given.
2, the debtor must have rights in the collateral.
Debtor has rights.
And 3, either the debtor has authenticated a security agreement that describes the collateral, or the secured party has possession or control of the collateral according to a security agreement.
Okay, that third one has options. Let's back up to value given. That seems pretty broad. What does that really mean?
It is very broad.
Yes.
It doesn't have to be new money flowing. It could be any consideration that would support a simple contract, extending credit counts, accepting delivery under a pre-existing contract, or even satisfying an old debt.
Okay. So old debt counts as value.
Yeah.
Now, here's where the outline gets really interesting. It talks about after acquired property. Can the security interest automatically grab things the debtor gets after the initial agreement?
It absolutely can, but,
Yeah.
and this is important, only if the security agreement specifically includes an after acquired property clause. You have to put it in writing.
Needs the clause.
Right. And even then, the security interest doesn't actually attach to that later property until the moment the debtor actually acquires rights in it.
Okay.
There are key exceptions, though. After acquired clauses generally do not work for consumer goods acquired more than 10 days after the lender gave value.
Interesting limit for consumers.
Yes. And they also generally don't attach to commercial tort claims that arise later. But they will automatically attach to identifiable proceeds from the original collateral. That's usually automatic.
Got it. And that security agreement requirement, the authenticated record part, is there a specific format?
Well, this is crucial. It's kind of the statute of frauds for Article 9. Usually it has to be an authenticated record, meaning signed or electronically marked with intent by the debtor, and it must describe the collateral.
Describe the collateral.
Yes, and the description just needs to make the collateral reasonably identifiable. It doesn't have to be super detailed like serial numbers always,
Yeah.
but enough that someone could figure out what property is covered.
The material points out a distinction here, right? Saying all the debtor's equipment is usually okay in the agreement, but all the debtor's assets isn't specific enough. Is that correct?
Correct. The security agreement itself requires a bit more specificity than just all assets. You need to make the collateral reasonably identifiable. All the debtor's equipment, or all inventory, generally works, but all the debtor's assets is considered super generic, and that's not sufficient for the security agreement.
Okay.
Interestingly, though, that super generic description can be okay later for the financing statement, which we'll get to.
Oh, okay. Different rules for different documents.
Exactly. The outline also notes that sometimes a new debtor, like a company that buys the original debtor's business, can become bound by an existing security agreement. And remember that third element of attachment. The alternative to the authenticated agreement is if the secured party takes possession of tangible collateral, like jewelry,
Right.
or gains control over certain intangible collateral, like a deposit account, and they do so pursuant to a security agreement. Maybe the agreement is oral in that case, but the possession or control provides the evidence.
And if the secured party does take possession or control, the source lists some rights and duties, like taking care of it.
Yes, they have a duty to use reasonable care with the collateral in their custody and keep it identifiable. But usually the debtor bears the risk of accidental loss or damage unless the secured party was negligent.
Okay.
The secured party can also charge the debtor for reasonable expenses incurred in storing or maintaining the collateral, and they might even be able to use or operate the collateral, say, to preserve its value or collect payments coming due on it. They can also sometimes notify a third party who owes the debtor money, think an account debtor, who owes on an account receivable to pay the secured party directly instead.
Right. Intercepting the payment. One last thing on attachment before we move on. PMSIs. What exactly is a purchase money security interest, or PMSI? Sounds special.
It is special. It gets special priority treatment later. A PMSI applies only to goods, including fixtures and software. It arises in two main ways.
Okay.
Either a creditor lends the debtor money specifically to buy the particular collateral, and the debtor actually uses that loan money for that exact purpose. The classic example is a car loan, where the loan money buys that car.
The loan enables the purchase.
Exactly. Or the second way is when the seller of the collateral finances the purchase price themselves. Like if you buy furniture from a store and they let you pay it off over time, taking a security interest.
Seller financing.
Right. For software, it's a PMSI if it's acquired together with goods in an integrated transaction, specifically for use in those goods.
Got it. And the difference between accessions and commingled goods, briefly.
Sure. Accessions are goods that get physically attached to other goods, but they retain their separate identity, like adding that fancy sound system to your car, like you mentioned. The security interest continues in the accession itself.
Okay.
Commingled goods are different. They are goods mixed together, like flour or grain, so their individual identity is lost in the mixture or product. The security interest then attaches to the resulting mass or product.
Right, like grain in a silo. Okay, so attachment makes the security interest valid between the debtor and the secured party. But this material stresses that perfection is how you establish your rights against the rest of the world. What's the key distinction there?
That's the crucial difference. Attachment is like having that private binding agreement. It works against the debtor. Perfection is making that agreement public or achieving legal recognition in another way so that other potential creditors, buyers, or even a bankruptcy trustee know about your claim on the collateral.
So it's about notice.
It's largely about notice, yes, or achieving a status that gives you priority. As the outline shows, you need both attachment and compliance with a perfection method to actually be perfected. It's about establishing your place in line, against third parties.
And this outline gives us 4 main methods for achieving perfection. What are they?
That's right. Article 9 provides these main pathways. 1, filing a financing statement. This is the most common method by far.
Why is settling?
2, possessing the collateral. Physically holding tangible items.
Possession.
3, controlling the collateral. This is for certain intangible assets.
Control.
And 4, automatic perfection. It just happens automatically upon attachment for specific types of collateral. No extra step needed.
Let's talk about filing, since that's the big one. What information is absolutely required on a financing statement? Is it complicated?
Actually, the financing statement is simpler than the security agreement in terms of content. The source lists just 3 essential pieces of information: the debtor's name, the secured party's name, and a description of the collateral.
Debtor name, secured party name, collateral description.
Got it.
And importantly, the debtor doesn't need to sign the financing statement itself. They must authorize the filing, but that authorization is presumed if the debtor authenticated a security agreement covering that same collateral.
Ah, okay. And the collateral description. You said it could be different from the security agreement.
Yes. Remember how all debtors' assets was too super generic for the security agreement?
Right.
Well, unlike the security agreement, that kind of super generic description is generally sufficient in a financing statement if it accurately indicates the collateral covered.
Huh. Why the difference?
Because the financing statement's main job is just to provide notice to put other searchers on alert that there might be a security interest. It tells them, hey, you should investigate further. It doesn't need the same level of specificity as the agreement creating the interest. It also doesn't need to mention after acquired property or future advances for perfection to cover them, as long as the description is broad enough. Okay, that makes sense. Now, the debtor's name seems like a tiny detail, but the outline makes it sound incredibly important. Why is getting that name exactly right so critical?
It's hugely critical. The whole system relies on people being able to search the public records accurately. And how do they search? By the debtor's name. So if your
Oh,
financing statement uses a name, maybe a nickname or a trade name, or misspells the legal name in a way that a standard search under the debtor's correct legal name wouldn't find it, your filing is considered seriously misleading.
seriously misleading.
Right. And if it's seriously misleading, it's generally ineffective, meaning your security interest might be unperfected against those people searching.
Wow.
The outline gives specific rules. For individuals, many states say use the name on their current, unexpired driver's license. For registered organizations like corporations or LLCs, you must use the exact name shown on the public records where it's organized. Trade names alone are definitely not enough.
So really need to get the official name.
Absolutely. And if the debtor legally changes their name later, making the filed name seriously misleading, the secured party has just 4 months to file an amendment with a new name. If they don't, they lose perfection for any collateral the debtor acquires after that 4-month period.
4 months. Okay, that's a tight window. So where do you file this magical piece of paper? Or electronic record, presumably?
Usually electronically these days, yes. Generally, you file centrally with the Secretary of State or equivalent office in the state where the debtor is located.
Where the debtor's located. How do you figure that out?
Article 9 has rules for that too. An individual is located at their principal residence.
Okay.
An unregistered organization, like a general partnership, is located where its chief executive office is.
Chief Executive Office.
And a registered organization, a corporation, LLC, limited partnership, is located in the state where it is organized or incorporated, the state whose laws govern it.
Got it. State of organization.
The major exception to central filing is when the collateral is related to real property. Things like fixtures, timber to be cut, minerals. For those, you usually file a special fixture filing locally in the county real estate records where the land is located.
Local filing for real estate stuff. Makes sense. How long does a standard filing last? Does it expire?
It does. Typically, a financing statement is effective for 5 years.
5 years.
If the debt is still outstanding or the lending relationship continues, the secured party has to file a continuation statement to keep it going.
Ah, continuation.
Yes, and you can only file that continuation statement within the last 6 months of the 5-year period.
Last 6 months only.
Right. File it too early, it doesn't count. File it too late, after the 5 years runs out, it's too late, the perfection lapses. And if it lapses, the security interest is treated as if it was never perfected against anyone who bought the collateral or got a lien on it while it was perfected. It's a harsh result for missing that deadline.
Wow, yeah. Need to stay on top of that. Okay, filing makes sense as the main public notice method. What about those other perfection methods? Possession.
Right, possession.
Like-
For tangible collateral things you can physically hold, like goods, instruments, money, tangible chattel paper, the secured party can perfect simply by taking physical possession of the item. Think of a pawn shop holding jewelry.
Mm-hmm.
Perfection lasts only as long as they maintain possession, though. If they give it back, perfection is usually lost unless another method applies.
Okay. And control.
Control is the method used for certain intangible collateral where possession isn't really possible. Things like investment property, deposit accounts, letter of credit rights, and electronic chattel paper.
Intangibles.
Yeah. Gaining control usually involves specific steps outlined in Article 9, depending on the type of collateral. For example, the outline explains how to get control of a deposit account.
How does that work?
Well, one way is if the secured party is the bank where the account is held. Another way is if the bank, the debtor, and the secured party all sign an agreement saying the bank will follow the secured party's instructions about the account without needing the debtor's further consent.
The three-way agreement.
Right. Or the secured party can become the bank's actual customer with respect to that deposit account.
Yeah.
And importantly, the outline stresses that control is the exclusive method for perfecting a security interest in deposit accounts and letter of credit rights. Filing doesn't work for those.
Only control. Good to know. What about automatic perfection? That sounds easy.
It is convenient when it applies. Automatic perfection means the security interest is perfected the instant it attaches, automatically, with no further action like filing or taking possession needed.
What gets that treatment?
The key example the outline mentions for indefinite automatic perfection is a PMSI in consumer goods.
The PMSI again in consumer goods.
Yes. So if a store finances your purchase of a new refrigerator for your home, their purchase money security interest is automatically perfected as soon as the sale happens and you have rights in the fridge. They don't need to file a financing statement.
Okay.
But the outline specifically points out this automatic perfection for a PMSI only applies to consumer goods. It does not apply if the PMSI is in inventory, equipment, or farm products. You generally have to file for those.
Got it. Consumer goods only for automatic PMSI perfection.
Right. There are also some types of temporary perfection mentioned, like you get 20 days of temporary automatic perfection for proceeds or for instruments or certificated securities if you gave new value under a security agreement, or if collateral is temporarily released to the debtor for certain purposes like sale or processing.
Okay, short term.
And there are also grace periods if the debtor moves to another state, usually 4 months to re-perfect, or if collateral moves, sometimes 1 year if perfected by possession.
Lots of timing rules. And proceeds. We touched on attachment to proceeds. What about perfection of the interest in proceeds? If my interest in the original collateral was perfected, does that automatically cover whatever the debtor gets if they sell it, like the cash?
Good question. The outline confirms that yes, a security interest in proceeds is automatically perfected for 20 days from when it attaches to the proceeds if the interest in the original collateral was perfected.
Okay, 20 days automatic. What happens after 20 days?
Perfection can continue indefinitely beyond 20 days under certain conditions. For instance, if the proceeds are identifiable cash proceeds.
Cash is easy.
Right. Or perfection continues if the original financing statement was broad enough to cover the type of proceeds received, like if it covered inventory and accounts, and inventory was sold creating accounts. Or if the secured party files an amendment to the financing statement covering the proceeds within that 20-day window. There's also something called the same office rule. Perfection continues if the proceeds are collateral, for which a financing statement would be filed in the same office as the original filing, unless the proceeds were acquired with cash proceeds. Gets a bit technical there.
A little bit, yeah. And a quick note on vehicles, like cars.
Ah, yes. Very important exception. For most vehicles covered by a state certificate of title statute, think cars, trucks, sometimes boats or mobile homes, perfection is usually achieved not by filing an Article 9 financing statement, but by having the secured party's lien noted directly on the certificate of title.
On the title itself.
Exactly. That notation on the title serves as the public notice. This is a major carve-out from the standard Article 9 filing rules. Though cars held by a dealer as inventory are often perfected differently, usually by filing.
Okay, certificate of title is key for most vehicles. Got it. So we've covered how a security interest is created, attached, and how you make it effective against third parties, perfected. But now the crunch. What happens if multiple people have legitimate claims on the same collateral? This is the crucial stage of priority, right? Deciding who gets paid first.
Exactly. Priority. This is where Article 9 really earns its keep, by providing a set of rules to sort out these competing claims on the same collateral. The source identifies the potential claimants we need to worry about, various types of creditors, transferees or buyers of the collateral, and of course other secured parties.
Let's start with creditors. How does a secured party stack up against, say, a regular unsecured creditor? Someone the debtor just owes money to with no collateral involved.
The unsecured creditor is generally at the back of the line. The source makes it clear that a security interest, even if it's unperfected, has priority over a general unsecured creditor. Just having that Article 9 interest gives you a leg up.
Okay, so even unperfected beats unsecured. What about a judicial lien creditor? Someone who sued the debtor, won, and got a court order creating a lien on the property.
Okay, that's different. A judicial lien creditor, someone who obtained a lien through the legal process, beats an unperfected security interest.
Unperfected loses to a judicial lien.
Right. But if your security interest is properly perfected before the judicial lien arises, the perfected security interest generally wins. It has priority over the later judicial lien.
Perfected beats the lien creditor.
Usually. However, there's a key exception we mentioned related to PMSIs. Remember that 20-day grace period for perfecting some PMSIs? Well, a PMSI that's perfected by filing within 20 days after the debtor gets possession of the collateral actually has priority over a judicial lien that might have popped up between the time the security interest attached and the time of filing. So that grace period can save you against a lien creditor.
Retroactive priority for PMSIs against liens.
Okay. The outline also mentions a limit on future advances. Advances made more than 45 days after someone becomes a lien creditor might be subordinate to that lien, unless certain conditions are met.
Okay. What about those non-consensual liens, like the mechanic's lien example? If you take your car for repairs and don't pay.
That's a great point and a really important priority rule. The source states that a possessory lien, meaning the lien holder, has possession of the goods that's given by statute or common law, which secures payment for goods or services provided in the ordinary course of business concerning that collateral. Like that mechanic's lien or an artisan's lien, generally has priority over any Article 9 security interest in the same goods, even if the security interest was perfected first.
Wow, so the